What we do here is go back.
Good morning, guys. Good morning, guys. Sorry, I've been gone for a couple days. I haven't really been gone, actually. I've been here the whole time, but we had some crazy, crazy severe snowstorms back in here. We actually got snowed in for a day. The only way we were able to get out, we actually had to take the snowmobiles out to the main road, which then was plowed. We ended up hooking up and we were able to plow ourselves back out. But so in the meantime, there was pretty much we had to run everything off the generators, which is nice that we have like a really nice generator set up here. Yeah, no internet, none of that stuff. I did have cell phone service. It was kind of in and out throughout the day, Sunday, Monday. And then yesterday, I was able to finally go into town and get a hold of. I had to go. So we had the issues. We think somebody actually. We thought it was just because of the storm, but once the storm had stopped, it didn't come back. Somebody actually had hit one of our telemark boxes. Dealt with that. But the nice thing was is that I was able to sit down and go through a bunch of stuff with the stream. So essentially I've got it right now, and we'll test it today and see. So far it's been working really, really nice and smooth, but we basically got it so that the latency issue is way, way less. So we're almost in real time. It's about when I tested it, it's about 6 seconds to maybe 8 seconds of delay, as opposed to most that do it are about 30 to 45 seconds. So we'll see if this works. The only problem is that I'm concerned is that a lot of you will have to rebuff often, which I've only had one issue with it when I was testing it yesterday. So we'll see what happens. We'll try this a couple times. It won't be as sharp. It won't be as high def. I don't really see that being a problem, considering that we're mostly looking at charts and stuff like that. So I don't think it'll. We'll see. We'll give it a go. See what happens. So sitting here pre-market, as you can see on the ES chart right now, we are going for that all-time line. Once again, that was set yesterday during market hours. I always like to see the records. When we hit record highs, all-time highs, I like to see them, whether it's in a stock or in an index fund. It's nice to see them hit during market hours for multiple reasons, but mainly because of the volume. Makes it stand a little bit stronger. So you can see as of right now, we are going back up for that all-time high here once again. I do think we will see, there's been a lot of good earnings, so I think a lot of this push with that, and coupled with the China news, basically what they're saying is that we're seeing a decline once again for, I think would be the second or third day that we've seen a decline in the numbers. I actually had the article pulled up here. Some good earnings too. While I'm pulling this up, I'll go over some of the earnings stuff. So we actually had some really good earnings. Also, Shopify, which we alerted to last week several times. I kept bringing it up. It did post better than expected earnings on all sides. It beat, so it is starting to rip really nice here. Pre-market, NVIDIA. Also one that we had kept pointing out. It has not posted earnings yet, but I believe it's tomorrow afternoon after the close. But it's get that little rally into the into earnings. We called out chips last week. I alerted to that several times, both on stream and in the chat, and there's several reasons for that. A lot of it had to do with the declining Chinese scare, because all of those chips were severely impacted from all of that coronavirus news. And so as soon as that started to subside, just even the slightest, those chips were poised to take off. At technical levels, it gave them a lot of room to breathe, which they needed. We needed a pullback kind of generally all over the place, and that's exactly what we've been saying. And that's why, we jokingly keep saying, BTFD, but we're kind of serious at the same time. And this is why. It can't just keep going up, because when it keeps just going up straight up, it's going to kind of fall over, right? So we needed time to break and breathe, and that's exactly what this gave us. If anything, this was a healthy thing. It gave everything a chance to breathe, and the big things impacted by that were going to be things like chips, Apple, Microsoft, anything that had kind of taking a hit from that, it was bound to take a rubber band, bounce back up. So NVIDIA, MU, I really like. AMD, obviously, we saw some great action from that last week and into this week. So some of the stuff I was talking about with the outbreak. So it was traders continue to monitor the impact of the coronavirus outbreak. As of Tuesday night, China's National Health Commission had reported 97 additional deaths, with total confirmed cases passing 44,000. However, the pace of new reported cases appears to be slowing down. Investors showed resilience by pushing stocks back to all-time highs, especially in the U.S., anticipating a strong V-shaped recovery when this is over. So that's from a macro analyst. But so that's kind of what we're talking about, is that it needed to pull back enough to kind of reset things, especially like RSIs and stuff like that. And not that those indicators really matter, but those indicators do just show how much We needed that when we were so overbought, and everything was it was at maximum levels all over the place. So it was bound to happen, and it was bound to snap back up with things like chips and such. So this morning, as posted in the description, CVS posted earnings as well. They also beat on both fronts. There was a little bit of whipsaw action in CVS this morning. At first, they just couldn't I think it was as the news was coming out kind of thing. But then Shopify posted, and as I said here in the description, and as I was talking about last week when I was alerting to Shopify, the reason that I saw such a bullish trend in Shopify is not only that it was on a massive uptrend and then it consolidated for about a week. We knew that the numbers from Black Friday and the numbers from Cyber Monday were going to come out. We had seen record sales on both of those days, so I saw almost little to no chance that those numbers were not going to be either fantastic or greater than that, and they were. They were some of the record-breaking numbers that they have ever seen. So that right here is pushing Shopify up even harder here at pre-market. Obviously, that long trade essentially at the moment is a little bit, would be chasing right now. However, depending on the price action, this thing could just absolutely skyrocket. But at that point, I would imagine somewhat of a pullback. But like I've been saying on Shopify for the last, I think it's been at least 4 months, anytime this thing pulls back or we get a red candle day, buy those dips, you guys. When these things are trending up, and anytime something is trending up that strong, buy those dips. There's little to no risk. Like, the risk is going to be so minuscule that if you're chasing it, you take a huge, gigantic risk. But if you watch something that's trending up that strong, and the moment that it falls back, then you buy those dips. Almost every single time on Shopify, literally, I think there was one time that this didn't work, where we had a red day where it pulled back, a decent, $12 to $20, and the next day, if not the day after, it was ripping $20-$40. So it's worked out very, very well. So obviously, chasing it at the moment, right at this moment, is probably not a very smart idea, risk to reward idea. But watch this thing, keep it on watch, as I do. It's on the chart here every day. Every day we stream, you guys can see it on there. I talk about it every single day. I go through the levels probably 5-6 times every morning, and at least 30 times a day, literally. So just keep watching it. Wait for an entry. I would say the entry will be when it pulls back in, and we'll go over it as soon as the market opens, and we can kind of see some price action moving around on it. So we'll talk more about Shopify. Trying to see what else I had on here. Teva, they posted earnings. They beat, but that actually started trading over in Europe, so there was already price discovery on that. What else did I have on here? There was a few other ones that were important this morning. So the Sprint T-Mobile deal, it hasn't gone through, but they are saying that it is looking really, really strong in their favor that this is going to pass. I saw some of you guys talking about it in Discord. That's a potential fantastic trade. Again, I wouldn't just jump right in right away because the move has already happened. However, once again, I would wait for, to see some consolidation or a pullback. The thing is that there are a lot of people voicing their concern right now. So it's going to be kind of whipsawing. I do think it's going to go through unless something drastic happens in one of these court battles. Looking through some of these, we got a bunch of trade ideas. I have so what I've been doing too is every night. So now the way the format's doing it, where Darth is posting those market outlooks, actually well before, like at the night before, like last night he did. So then I'm putting those into a separate watch list. I have it's Darth's list, and then I'm marking all those levels and what he is talking about. So that way, I can kind of keep everybody on track as far as, so we're not having conflicting information on that stuff. So I'm just kind of looking through his stuff on there. There's some good stuff on here. I think one of the really big ones that I think people need to be keeping an eye on that Darth brought up is going to be Lulu. Lululemon has just been absolutely ripping the last year. well, not the last year, but the last several months. I mean, it's been going since, I'm thinking, I saw for earnings this summer. So it was a quarter two earnings. So this summer when they really started to push up. And I think it's just that the company was already doing quite well, but I think that they had to catch up, back up to their price discovery. So that happens sometimes with some of these IPOs. What else do we have in here? Yeah, everybody's got NVIDIA. I think that's one to watch. The problem is now that we're getting closer because we've got earnings tomorrow. The implied volatility is starting to really move, and you'll see just from this morning till this afternoon how much higher that implied volatility is going to be, and then even till tomorrow. I mean, these are sometimes those trades where you could buy like a straddle, and both sides will make money because the implied volatility pushes up so high that even though you're losing, say, on your puts, to the downside, you're still making money because the implied volatility is pushing those prices up so high. So that is something we'll definitely be watching. So I'll be watching for some of the correlation trades off of that. Same with Shopify and NVIDIA. So I'll be watching like MU, CRUS, Serious Logic, CRUS. Same, and that's also beneficial from Apple. So those are some of the pairs that I watch as far as like the chip stuff goes. So a lot of times if I can't, like NVIDIA, I don't want to risk a huge amount on that trade, thinking that the big run is probably somewhat over, even though it probably will continue to push up into earnings, and it has earnings, so implied volatility is going to make it that much more expensive. Why not look at one of the other correlated trades like MU or even AMD or Serious Logic, which is CRUS. I don't bring that one up as much anymore, which I should, because it actually is a really good price level, and it's a nice little trade. Before the market opens here, let's go ahead and look. Let's look at. Take a look around the market here real quick. Let's look at futures. Starting from the upper left, we'll just skip over to XLF there in the middle. So financials are pushing up beautiful this morning. We're already up to 31.29. We'll see if that can continue to hold on to those gains, if that's going to sell off out of the market. Oil having a beautiful day here, pushing up 3.3% at 51.73. The NASDAQ is up about 0.5%. So is the ES. We're both up about 0.5% right in there. You can see gold did push up a little bit from the lows of 1564.40 last night, but it is starting to sell off a little bit here this morning. Below gold, /ZN is the 10-year. That had a similar price action where it had kind of pushed up a little bit, but it's starting to sell off. And below that, on the very lower right corner, /ZB, those are bonds. This is what I'm always talking about and watching. Bonds starting to sell off a bit too. So this is some bullish looking action going into open for sure. As well as the FANG stock. So starting to the upper left, Facebook. It is pushing up a little bit here. I believe we closed yesterday at 207.19. We did push up a little bit. We almost hit 208.40. We're just sitting at 207.85 right now, 208. So the bid ask is right at 208. Apple looking really nice and strong here overnight. We are up at 321 from 319. Amazon is also up at 21.66 from 21.50. Netflix also up 377 from 373. Google is up around 15.17 from 15.10. And Microsoft looking pretty strong. Had a really nasty day, and especially on the daily candle. That thing was looking pretty nasty. But it's because it had just been on an absolute rip, and that's what I'm talking about. When those things just keep pushing up like that, you guys, they literally are going to fall over backwards. So not too surprised there. So Shopify, it closed yesterday at 492. And it's already pushed up clear up to 569. So big rip for Shopify after earnings. So that will be interesting to see if that thing will continue to sell off or it pushes up, and it opens up 15% on the day as the market opens. Wow, that is absolutely insane. Definitely expected though, but just crazy. So let's go ahead and open up and see where we can watch our ticks. So we are opening our ad decline up at 12.95. That is a beautiful start to the morning from yesterday. We are climbing at 13.02 already, ticking extremely strong, up at over 1,000, hitting 9.99. Our breadth indicator is nice and positive here. So everything so far is looking quite bullish. I believe everybody just needs to pay attention to the ES numbers that ADA continues to post. in Discord, as those are exactly what we'll be following for the overall market here. Let me look. So yeah, we're hitting these big 1,000-point ticks. These are super extraordinarily strong. This is just awesome. And then add decline line pushing up nice and strong. I will expect that we'll most likely get a big push up here and then bounce back down a little bit, because there's no way it'll be able to sustain that. I think we'll go for a little bit here and then push back down. I mean, we're still up only not even 0.5% yet here. So let's see here. Where did I put all that info? Huh. And I can't remember, but I think Powell speaks twice this morning. I think he already spoke, or the Fed speaks, because Powell, I believe, spoke at 9, or no, he spoke right now. Is it right now? Maybe 9:30. I had it listed somewhere. I put it in the okay. It's in the description. If I just read my own description, but yeah. So and then I'm not sure when the second time is. I'll see if I can figure that out. Did I put it in here? I don't think I did. But I know that they speak twice today, so that I want to be a little bit careful around that. Oh, and also keep an eye on Google, guys. They are in court today they're battling one of 3 of those European Union antitrust law court battles, so they'll be fighting that today. So Google, I'll be keeping an eye on to see what does happen off, because tech kind of monsters of tech, especially in big tech, is kind of backed off just a little bit. I mean, we're at such huge high levels, it's expected. But I will definitely be wanting to watch that to see if tech cools off too much. Then we could have, we could watch this thing could just absolutely tip over, especially if financials don't continue to hold up like they have been. Yeah, day 2 of Fed Chairman Powell testimony on the economy and monetary policy as he speaks to the Senate banking panel at 10 a.m. Okay. So here we go, pushing up on all-time highs here. There we go, all-time highs, boom, 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 after yesterday. So that'll be our new high so far. But yeah, so Powell speaks today here at 10. So just not too long here, in about 25 minutes, 27 minutes. So I'm going to go ahead and move this, as we are setting a new high. I'm sure I'm going to end up having to move this a million times, so I might just clear it off for the morning and see if we're just going to keep pushing through it. I think we're having such nice large ticks. We've got this beautiful advanced decline line continuing to push up bullish. These ticks are just hugely strong, and the breadth indicator already pretty up there high. So if this continued to go on all morning, it would be pretty significant. I don't know if that's what we're going to see, but I have a feeling we'll back off just a little bit. But right now, just absolutely pushing up beautifully. So no complaints there. Oh, Powell is speaking here, or I think they're getting ready to speak. I will definitely be watching this, so let's see if he's saying anything at all.
Undoubtedly helped fuel this strong economy and labor market. Americans are set to benefit even more when considering the effects of the USMCA and the Phase 1 trade deal with China. Despite this substantial progress, there are several external factors that could have a meaningful impact on the economic activity and our financial markets that need to be better understood, including the Fed's decision to maintain a significantly larger balance sheet in the future, including its recent decision to purchase Treasury bills in response to volatility in short-term borrowing rates. The Fed's future plans to maintain stability in short-term borrowing rates, including potential structural market-based fixes, and risks of transition away from LIBOR to an alternative reference rate, steps that should be taken to ensure a smooth transition and curb risks to businesses and financial markets. And finally, the potential impact of the coronavirus on global commerce and growth. The Fed has also taken a number of important supervisory and regulatory actions that merit attention. The Fed and other federal financial agencies recently proposed amendments to the Volcker Rule that would improve, streamline, and clarify the covered funds portion of the rule. That proposal builds on the agency's simplification of the Volcker Rule in 2019, standing to improve market liquidity and preserve diverse sources of capital for businesses while striking the appropriate balance with safety and soundness. Additionally, many Banking Committee Republicans and I have raised serious concerns in the past with the agency's supervisory and examination processes, including the use of guidance as rules. In January, Fed Vice Chairman Quarles offered a roadmap to foster transparency, accountability, and fairness in bank supervision, including tailoring the supervisory framework to better align with the categories developed under the Fed's domestic and foreign bank tailoring rules, putting significant supervisory guidance out for public comment and submitting it to Congress under the Congressional Review Act. Other common sense improvements to the supervisory process, such as a rulemaking that would cover the agency's use of guidance in the supervisory process. This roadmap is greatly encouraging, and I urge the Fed to take steps to put it into motion. Finally, there is a constant innovation, including in the financial services industry, to increase resources to unbanked and underbanked populations, reduce friction in payments, and increase efficiency in the delivery of financial products and services. Some recent examples are Facebook's announcement of Libra, a new stable digital cryptocurrency backed by a reserve of real assets and leveraging blockchain technology. Work by global governments and central banks to explore the development of central bank digital currencies, especially amid rumors that China's launch of a digital yuan is imminent. The numerous applications of distributed ledger technologies, including in clearing and settlement, identity verification, and cross-border transactions, and some financial institutions' adoptions of public cloud technologies. As I've stated in past hearings, it seems to me that technological innovations in this space are inevitable and that the U.S. should be leading in developing what the rules of the road should be. During this hearing, I look forward to hearing your thoughts, Mr. Chairman, on these important issues and about the work that the Fed is engaged in to appropriately address them. And again, thank you for joining us today. Senator Brown.
Thank you, Mr. Chairman. And Chairman Powell, nice to have you back, and thank you for your accessibility and the conversations you have with all of us in both parties on this committee. Before we start, I want to say a few words about what happened last night when we got word that Jessie Liu's nomination had been withdrawn. She was to appear in front of this committee.
Yeah, well, I'll wait for that. I wanted to hear that first part. I'll continue to listen to it, and as soon as anything comes up, I'll pull it back up there. But
And my friends say that the president would be chastened by impeachment. Some of you told me you knew
nothing too
was wrong.
nothing too pertinent yet. I mean, it's just this is the same thing they keep talking about over and over and over, where they
But that also said
where they keep talking about watching the emerging markets, watching the virus and its implications on the world, and its world implications, and et cetera, et cetera. Yeah, it wasn't me being too loud. It's the way that they put the thing out so it distorts. But I just put it back. I just rerouted it through the mixer so I can control it, even though the quality will be a little bit weirder. But when he comes on, I'll play it, because I think these guys are just going to talk a bunch here this morning at first, because I don't think he's supposed to come on for another 20 minutes or so, and he's the only one. I mean, it's not that he's going to say anything different or anything pertinent. It's just that the market sometimes will really move around what he has to say, so that's why I want to be paying attention to it. So that's really all. Let's see here. Where is this all going?
Yesterday, and the reason I'm bringing this up today is he continued the tour, interfering at the Department of Justice, strong-arming political appointees to overrule career prosecutors. Those attorneys withdrew in protest. Those professionals, I have no idea their political party, they're professionals, withdrew in protest from the case, and at least in one case resigned entirely from the department. We cannot not give him a permanent license to turn the presidency and the executive branch into his own personal vengeance operation. You all know it's happening. Even the senator that just walked out knows that it's happening. I'm afraid that's what we're seeing, a personal vengeance operation. No one should be above the law. If we say nothing, and I include everybody in this committee, I include myself, if we say nothing, it will get worse. His behavior will get worse. The retribution tour will continue. We all know that. Mr. Chairman, now on to the issue. Chairman Powell back. Earlier this week, Bloomberg reported on a profitable and fast-growing Spanish company. Grifols has opened up branches in 36 states. They buy and sell plasma, nice clinical-sounding word that means blood, as we know. Americans who are struggling to make ends meet are lining up to sell their blood to put food on the table. The blood harvesting business is booming. Grifols stock is doing great. It's hard to think of a better metaphor for the Trump economy. On Monday, the S&P 500 and NASDAQ both reached record highs. 2019, J.P. Morgan Chase had the best year for any U.S. bank in history, $36,000 million in profits. Big corporations are spending hundreds of billions of dollars on stock buybacks and dividends. On paper, the economy's been expanding uninterrupted for over 10 years, although the growth in the last 3 years of the Obama administration has been greater than the growth of the first 3 years of the Trump administration. You know that too. But if you talk to the vast majority of people who rely on paychecks, not investment portfolios to earn a living, you get a very different story. They've been bleeding for years. Most families don't understand why the harder they work, sometimes at more than one job, the harder it gets to afford pretty much everything: childcare, healthcare, rent, college tuition. People in this room may remember last September when the financial industry went into a panic over a benchmark interest rate passing 10%. Wall Street faced uncertainty, so we respond. Fed leapt into action. Smart government employees came up with a plan that led to the Federal Reserve lending about $200 billion every day into financial markets through a mechanism that hasn't been used since the financial crisis. $200 billion.
Yeah, still nothing. I think I'm just going to wait for Powell, like I said. This is kind of the same.
It's in everybody's interest, Mr. Chairman, for banks to keep lending money and credit to keep flowing so businesses can invest and manufacture, consumers can buy houses and cars. My problem.
That's kind of funny. One of the comments they were on there, they're like, I thought this was about banking, not Trump. And it's like, do you not realize how stupid that is? It's like, it kind of matters here. So we are backing off a little bit. We hit that high of 33.77 roundy here. I'm going to go ahead and move this while I can. I was going to wait for a while, but I think we're going to hold this for a minute. And we did break through some key levels this morning, so nothing too surprising here. Maybe a breather and push up, or we can continue to sell off. I think it's going to be a bit of a matter of what comes out when Powell speaks as well. So that'll be interesting to see, especially if the market even moves around it at all. So it'll be strange. Yeah, they're talking about credit card debt and all that stuff. So they're just going to bring up all the economy stuff here until they get into Powell speaking. So keep getting some really nice, strong ticks here. So that's good. Let's see here. I want to see what's going on. So VIX has pulled in about 4.28%. We're sitting at about a 1453. The VVIX is actually up about 2%. So that is something to keep an eye on. But as I'm saying that, you can also see that on the right-hand side, gold, bonds, and 10 years are all continuing to sell off from this morning. Oil did tap a high of 51.73, but has backed off a bit there. So that was a nice big push up. XLF, those financials are really, really looking nice and holding stuff up here. They are up at 31.31, so about 0.63%. So that's huge, holding up right now. You can see most of this. These fangs are really looking really strong here and holding this up. So this will be interesting to see. I mean, Facebook's still up about 0.8%. Apple's up 1.1%. Amazon 1.26%. Netflix 1%. Google the lowest, and it probably has something to do with the court battle that they're in right now. I'm sure some of that news is getting people backing off just a little bit this morning. And Microsoft obviously continuing to dump a little bit here after that nasty day yesterday. I want to actually pull this back for reference. So you can see, I mean, we were clear up here at a high of 191.40, and we're down all the way to 183.46. And for Microsoft, that's a pretty significant fallback. So yeah, that'll be something we'll definitely be keeping an eye on for the next couple days. I do expect when the selling is over that there's definitely a buying opportunity in Microsoft. So that is definitely something that, Spartacus, I don't know if you're on here or not, but yes, I'm definitely still in. A lot of my sell orders were in from 9,800 to 10.2, and then I left a couple runners, so I've got about 30% of my position left, and I'm going to hold on to it. I'll see if it falls below 96, then I'm out. But if I want to see if we're going to get that push up towards 12, I don't think it's going to make it on this first go, but I'm extremely bullish. I mean, we had that giant spike last night from 98 all the way to 10.4, so I'm a little bit skeptical that we're going to sell back off. He's asking me about Bitcoin, guys. That's what I'm talking about. So I'm not sure if he's on here, but I'll answer him in Discord too, but I'm not sure if he's able to listen or not. But so yeah, still looking very, very bullish right now on that. What did I want to look at here real quick? Oh, I wanted to look at these guys. So Boeing is up about $3, so just under 1%. Roku looking nice and strong. It had a beautiful morning and then sold all off pretty much yesterday, but it held on to that upper celt. You can see there on the 4 hour, so still looking nice and strong here. Still up about 2.7%. Activision having another nice day here. Regaining that upper celt on the 4 hour, so it is up 1.46%. Shopify holding on to some of the gains, but it hit that high of 593.89, and it's backed off significantly. I'm sure it was a lot of profit taking because a lot of those people were probably holding for earnings, so I'm sure they're backing off a bit here. So still up 14%. Nvidia up 0.68%, and Tesla is actually still up 0.47%. Baba up 2%, Baidu up 1.7%, AMD 0.3%, Qualcomm is up 2.5%, Disney up about 0.6%, and McDonald's 0.1%. So literally everything is green as of right now, and I think Powell is speaking right now. So let's see what he has to say. Yeah, here he is. Hold on.
Disruptions in China that spill over to the rest of the global economy. Inflation ran below the FOMC's symmetric 2% objective throughout 2019. Over the 12 months through December, overall inflation based on the price index for personal consumption expenditures was 1.6%. Core inflation, which excludes the volatile food and energy prices, was also 1.6%. Over the next few months, we expect inflation to move closer to 2%, as unusually low readings from early 2019 drop out of the 12-month calculation. The nation faces important longer-run challenges. Labor force participation by individuals in their prime working years is at its highest rate in more than a decade. However, it remains lower than in most other advanced economies, and there are troubling labor market disparities across racial and ethnic groups and across regions of the country. In addition, although it is encouraging that productivity growth, the main engine for raising wages and living standards over the longer term, has moved up recently. Productivity gains have been subpar throughout this long economic expansion. Finding ways to boost labor force participation and productivity growth would benefit Americans and should remain a national priority. I will now turn to monetary policy. Over the second half of 2019, the FOMC shifted to a more accommodative stance of monetary policy to cushion the economy from weaker global growth and trade developments and to promote a faster return of inflation to our symmetric 2% objective. We lowered the federal funds rate target range at our July, September, and October meetings, bringing the current target range to 1.5% to 1.75%. At our subsequent meetings, with some uncertainties surrounding trade having diminished and amid some signs that global growth may be stabilizing, the committee left the policy rate unchanged. The FOMC believes that the current stance of monetary policy will support continued economic growth, a strong labor market, and inflation returning to the committee's symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy will likely remain appropriate. Of course, policy is not on a preset course. If developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Taking a longer view, there's been a decline over the past quarter century in the level of interest rates consistent with stable prices and an economy operating at its full potential. This low interest rate environment may limit the ability of central banks to reduce policy interest rates enough to support the economy during a downturn. With this concern in mind, we've been conducting a review of our monetary policy strategy, tools, and communications practices. Public engagement is at the heart of this effort. Through our Fed Listens events, we've been hearing from representatives of consumer, labor, business, community, and other groups. The February Monetary Policy Report shares some of what we've learned. The insights we've gained from these events have informed our framework discussions as reported in the minutes of our meetings. We will share our conclusions when we finish the review, likely around the middle of this year. The current low interest rate environment also means that it would be important for fiscal policy to help support the economy if it weakens. Putting the federal budget on a sustainable path when the economy is strong would help ensure that policymakers have the space to use fiscal policy to assist in stabilizing the economy during a downturn. A more sustainable federal budget could also support the economy's growth over the long term. Finally, I'll just briefly review our planned technical operations to implement monetary policy. And the February Monetary Policy Report provides details of our operations to date. Last October, the FOMC announced a plan to purchase Treasury bills and to conduct repo operations. And these actions have been successful in providing an ample supply of reserves to the banking system and effective control of the federal funds rate. As our bill purchases continue to build reserves toward levels that maintain ample conditions, we intend to gradually transition away from the active use of repo operations. Also, as reserves reach durably ample levels, we intend to slow our purchases to a pace that will allow our balance sheet to grow in line with trend demand for our liabilities. All of these technical measures support the efficient and effective implementation of monetary policy. They are not intended to represent a change in the stance of monetary policy. As always, we stand ready to adjust the details of our technical operations as conditions warrant. Thank you. I'm happy to take your questions. Thank you, Chairman Powell. And as I said before, I won't use my 5 minutes for questions. And in fact, I will not use much of my 5 minutes at all, trying to set a standard for the rest of the members of the committee. Before I turn the time to Senator Brown, however, and yield my time, I wanted to indicate that it's been brought to my attention that Senator Shelby, who unfortunately isn't able to be here right now, recently became the longest-serving member of the Senate Banking Committee in history. He began his service on the committee on January 6, 1987, and has now served approximately 33 years, 1 month, and 6 days. That surpasses Senator Sparkman, interestingly also of Alabama, who previously served on the Banking Committee between January 6, 1947 and January 3, 1979, almost 32 years. Senator Shelby has clearly seen dramatic changes in the financial services industry over those years, and himself has had a meaningful impact on financial institutions, markets, and consumers during his tenure on the committee, including as chairman. I take this opportunity to thank him for his service on this committee and congratulate him on this significant milestone. Senator Brown.
Is he here?
He's not here. I yield my time to you.
We'll clap again when he comes. Thank you, Mr. Chairman. Thanks. When the Fed says it's nearing maximum employment and the labor market is strong, it could mean workers have one good paying job, or it could mean that a worker is working under 40 hours at 3 part-time jobs at minimum wage. I think this highlights how the economic recovery hasn't benefited nearly everyone. You hear these statistics, 40% of, 50% of, 25% of people may pay half their rent and half their income in rent. 40% of Americans can't come up with $400. So clearly that's not reaching everyone. If you have to work 3 jobs, or if you're working a job in one of the 10 fastest growing professions, 7 out of 10 of those jobs are this, you still can't afford rent. Something is wrong. I appreciate you've been on a listening tour and looking forward to a report, but I want to know who do you have at the Fed working on bold and creative ways to use the Fed's authority, some tools we probably don't know about, using your authorities to help working families that aren't benefiting from economic growth? What can you do to make sure that most of our economic growth, not a sliver of it, but most of our economic growth ends up in workers' pockets?
Well, our tools are not focused on distributional effects, really. They're focused on aggregate effects. We do not have those tools. Other agencies do, and of course, elected officials hold the power to address those issues. But I will say that the thrust of our review of monetary policy, the first we've done of this nature, is to assure that we have the tools to carry out the mandate you've given us of maximum employment and stable prices in a world where inflation is trending lower, where the Phillips curve is very flat, so that the connection between inflation and tightness in the economy is very, very low now, and also where interest rates are quite low, which creates a very challenging environment for us to carry out the job you've given us, and that's why we're doing a deep dive on issues around our strategy, tools, and communications.
Okay, I ask you to, and these conversations can take place individually too, but ask you to be as creative as the Fed was. I mean, I just have a list here of extraordinary federal actions that didn't require Congress. I'm not arguing Congress has done its job. Senator McConnell and the president have refused to raise the minimum wage. It's been stuck for 11 years at under $8. They took away overtime for about 2 or 3 million Americans because of truncating the overtime rule. Tax cuts for the rich and now cuts for Medicare. I mean, we know Congress isn't doing its job to redistribute income in any way that's fair to hundreds of millions of Americans. We know that, but just this list quickly: the maiden lane direct purchase of assets, the primary dealer credit facility, converting investment banks to bank holding companies so they could borrow from the discount window. The Fed has been very creative to the country's benefit when Wall Street has reached difficult times, has run into difficult times, sometimes of their own making, but the Fed I'm a supporter of the Fed. Some people with my political philosophy aren't. And I think that you have stepped up in many ways. I ask you to be as creative in thinking of ways that this wealth is shared beyond the 1 or 2 or 5 or 10% who are doing very well, who are thrilled with the economy the way it is, and it just doesn't reach so many. One other question, Mr. Chairman. I'm worried about other risks in our economy. I'm glad the Fed's taking leverage lending seriously, incorporating it into stress tests. Same time, we're seeing the financial system get more and more exotic. JP Morgan Chase, through a supposedly unaffiliated fund, wants to buy an electric plant in El Paso, also owns a stake in a nuclear power plant. That means that JP Morgan Chase could likely own a nuclear power plant. The Japanese equivalent of Amazon wants to form an industrial loan company in Utah so it can get the benefits of being a bank without the regulation, and recently voted with other bank regulators to weaken the Volcker rule by reversing protections in the 2013 rule, allowing for more risky and leverage investments. Are we going in the right direction? It seems the financial system, again, is getting more complex, more exotic, things people don't understand. Shouldn't we be focused on simplifying it?
Well, what we are focused on is maintaining much higher capital, much higher liquidity requirements, stress tests, as you pointed out, that keep the banks on their toes and do address in a timely way the issues of the day, and also resolution planning. So those are the big four important measures broadly that we put into place after the financial crisis, and we're focusing on sustaining those, making them more effective, and keeping them strong. Senator Toomey.
Thanks very much, Mr. Chairman. Welcome back, Mr. Chairman. Good to see you again. I have several somewhat technical questions I'd like to go over with you, and some of them we've discussed to varying degrees in the past. But one is the Fed's real-time payment system. As you may recall, I was never convinced that this was a great idea for the Fed to pursue this, since we have a private sector system in place, up and running, and really encouraged by the Fed back in the day. But I get the Board of Governors has made its decision. Here's my question for you. A number of constituents have expressed the concern that we're going to end up with two systems that are not fully interoperable. And to the extent that employers and financial institutions and other participants would be plugged into different systems, if they are not fully interoperable, there's a real concern that that is going to, at a minimum, diminish the ability to innovate in these systems going forward. So I guess I'm wondering if you could just briefly, because I do have several other topics, just address the question of whether it is a priority of the Fed to ensure that the FedNow system will be fully interoperable with the clearinghouse system.
I think full interoperability is the goal. It will be challenging to reach it, but it's high on our priorities to assure interoperability. It's something we're very focused on in the design stage.
Okay, and as I'm sure you're aware, the clearinghouse system is committed to having flat fees and not providing discounts for volume and the size of transactions, provided that the FedNow system does not provide those kinds of discounts. Can the Fed commit that it will have uniform pricing on this platform?
We haven't made that commitment, and it's not clear that that's what that the banks who really wanted us to do this are looking for.
Well, I would just, this is often cited as a reason why the Fed needed to do this, is because the private system might discriminate on the basis of price. So I think it is important that the clearinghouse system has volunteered. Clearly, they are happy to be regulated if need be to ensure that this would occur. It would be really ironic and a shame if it turns out that it's in fact the Fed that makes it more expensive for small banks to participate. So let me move on to SOFR. So as we've discussed, one of the challenges of replacing LIBOR is that LIBOR has an embedded credit risk element. It's an interbank rate, whereas SOFR is a risk-free rate because it's essentially a repo rate. And that mismatch could conceivably create some problems especially to the extent that banks are funding themselves in an interbank market that's subject to credit spreads that SOFR may not reflect. And so a mismatch in assets and liabilities could become problematic. So my question is, I think yesterday you may have, and I didn't see the transcript, so correct me if I'm wrong, but you may have suggested that there's a thought of trying to introduce a credit component, some kind of credit spread or credit risk component as either a complement or an alternative, or somehow integrate that with SOFR. And I'm just wondering, did I get that right? Is that something you guys are thinking about? Are you concerned about it at all?
I'll just quickly say that LIBOR itself we can't assume that it will be published past the end of 21. So that hasn't changed, and everyone needs to take that on board. SOFR is going to be the rate that a lot of the derivatives go to, and other many across the broad financial system will go to. But a number of banks have come forward and said that they want to work on a separate rate, which would not replace SOFR, but would be credit sensitive. And so they're doing that now, and we're working with them to support that process. So we're open to that, but it doesn't mean that the transition away from LIBOR to SOFR will stop. It has to go forward.
Yeah, okay. Last thing on my list here, the glitch in the repo market. As you and I discussed briefly, my concern is when banks choose to earn less than 2% on excess reserves when they could be earning up to 10%, at least briefly, in the repo market. It suggests that there's something going on here, right? They could have put their money into the repo market. They chose not to. I'm not aware of an explicit rule that required that during the episodes when these rates spiked, but nevertheless it happened. And so I wonder, and I'm a little concerned, that there might be some kind of unspoken pressure on the part of regulators to favor cash on deposit with the Fed over the liquidity in the form of repo transactions that goes beyond what is actually in the rules. And I'm wondering if you share that concern, what you think about it. I know the Fed's response has been to provide liquidity, and that works in a given moment. But if there's an underlying problem that hasn't been fixed, then isn't there the risk that the spike in repo rates could reoccur, and you have to provide liquidity again? Could you address that?
Sure. So there isn't a preference for reserves over treasuries in the LCR, but there is in the internal liquidity stress tests, in the sense that it takes 1 day to turn a treasury into liquidity. Just inherently there is. And I think the idea of putting treasuries and reserves on an equal footing in terms of their treatment, so that they can achieve liquidity, is a good goal, because we don't want to tilt banks in the direction of having to have more reserves than they really need. As long as the overall level of liquidity is at the appropriate level, we don't want to tilt them in that direction. It may well be that we're doing that. You may have seen Vice Chair Quarles gave a speech on this and talked about this issue at some length. So we're looking at ways to address that, and one of which is just to assume that the discount window is available in that stress test, which is a reasonable assumption to make. But I do think there are things to do there. And the reason is, as you mentioned, there was liquidity, but it didn't flow, so it wasn't liquid. And so the question is, why not? And we're looking at ways to address that will not undermine safety and soundness, but that will make the markets operate better.
Thank you.
Senator Reid.
Well, thank you very much, Mr. Chairman. Let me thank you, Chairman Powell, for your leadership. Thank you for joining us in Providence. It was a wonderful evening. And I think it's important, too, that your efforts to ensure the independence of the Federal Reserve. Without an independent Federal Reserve, our national policy making is, in my view, severely flawed. So keep up your efforts, please. You mentioned that we've had an expanding economy for 11 years. By my count, that would be 8 years under President Obama and 3 years under President Trump. But the expansion is good. But there are still some issues I think we should address. The Pew Center put out a report in January, and they indicated that the share of wealth held by middle-income families has been falling for roughly 20 years. And I presume, I'd like you to comment whether it continues to fall despite this expanding economy. And in addition to that, they point out that income inequality in the U.S. has increased since 1980. If it's still increasing, please comment on that. And it's greater than in peer countries, other countries that are similar to us in many other aspects. So despite this expanding economy, if we're seeing a shrinkage of wealth in the middle class and income inequality, those are social and political and economic trends that I don't think are sustainable over time. They go to the fabric of the country. So are those trends continuing, and what policy can we adopt, both fiscal and monetary policy, to change them?
Those are longer-term trends that I think are driven by important underlying factors, many of them global. And so I think that I would assume that the data will continue to move in that direction. I think what they show is that incomes have been moving up across the income spectrum, particularly if you look at benefits, and if you look at after-tax effect, it gets more even that way. But it's been a particularly good time to be at the top end of the income spectrum. And I would point to two key problems I think we ought to address. One is low mobility. We actually have lower mobility from, say, the bottom quintile to the middle quintile or the top quintile than many other advanced economies. This is not our self-image as a country, and it's something we need to address. The other is just that the relative stagnation of those incomes in the middle and the low end. We want, of course, prosperity to be broadly shared, and it comes down to really education and training and things like that enable people to do well in the modern economy, which is a globalized economy that is less about manufacturing, and the manufacturing jobs are more technical than they were. So we need a workforce that can benefit from technology and globalization, and those are policies that the Fed doesn't have our hands on.
No, you don't have those policies, but if we just sit back, those trends will continue, and they'll cause even further divergence between the vast majority of Americans and a very small group of Americans. So it's incumbent upon Congress, the executive, to start taking steps. Is that fair?
I think so, and I also think U.S. businesses get this very much now. If you talk to business leaders, they see the workforce and the need for widely shared. We want prosperity to be as widely shared as possible. You hear that all the time from business leaders and certainly government leaders as well. I do think it's an important national priority.
Thank you. Just switching gears here, the Community Reinvestment Act is being massaged by both the Office of the Comptroller of the Currency and the FDIC, and there's been some comments critical of their efforts, both not just by affordable housing advocates, but by some banking institutions, that they are not doing a proper cost-benefit analysis, that their proposal unintentionally could discourage revitalization of neighborhoods that really do need it most. And can you let us know what role you might play and how you can help get it right?
Sure. So, first of all, we're not going to comment on their proposal, and it's out for a proposal. I think all of us, including the FDIC and the OCC, are looking forward to seeing those comments and learning more. I think we do share the goal of modernizing CRA. Technology and demographics have really changed the delivery of banking services, particularly in rural areas, for example, but everywhere. So it's time to do that. It hasn't been done in 25 years. I think we agree on the goal, which is we want it to be more effective, and it would help that if it were more transparent, more objective. So I think we share objectives with those agencies, and we work closely with them for a long time to try to get completely on the same page. We developed our own approach, which was slightly different, a bit different, and we weren't able to get together in the end. But I think we should look at it as an ongoing process where we'll continue to learn. That's going to be our approach.
Again, thank you, Mr. Chairman, and I'll stress independence one last time.
Senator Sass.
Thank you, Chairman. Chairman Powell, thanks for being here. We're grateful for your work. You have been consistently raising warning bells about what you call the greatest threat to the financial system. You talk to many of us in private about cyber issues, and you said it yesterday over on the House side. I don't think it's breaking through. Can you summarize for us why you're awake at night, worried about cyber attacks on our financial system?
Sure. So they kind of pay us to be awake at night worrying about things. And I would say that if you look at what happened in the financial crisis, we had a game plan there. We implemented it over the course of 10 years. I won't say that it's perfect or anything like that, but we have a plan that is meant to address those kinds of things. What's new in the threat environment is the ongoing level of cyber threat and the increasing sophistication of it. And so that's what we spend a ton of time worrying about that. And the Treasury Department has really been taking the lead on that. And I think, so we're very focused on it. We're focused on making sure that the financial institutions that we supervise are doing the best that they can to stay at the state of the art. Good cyber hygiene. It turns out that a lot of these things are just people failing to implement, updating their software and things like that. That's where a lot of breaches happen. So I mean, it's an intense focus by supervisors and by financial institutions, also by non-regulated, non-financial institutions, companies that are in, all kinds of businesses are having this now. It's an enormous focus. We'll never say that it never feels like we've done enough, but it's just something we keep trying to get better and better at. Lots of resources on it. In all the agencies and in all the companies.
And if you'd concretize for us, give us maybe two examples of a way that you think this attack could have, spillover effects. How do the dominoes work without giving somebody a template or a roadmap? You've talked in private a few times about ways that this could cause bigger consequences than 2008-9. How would that happen?
Yeah, without wanting to get too much into it, I would just say that confidence in the financial system is really important. The public has to have confidence in the financial system, and so a successful cyber attack on a payments utility, for example, would be challenging. We could address that, we could isolate it, we could fix it, but you would want to avoid somehow broader blows to confidence, because when confidence weakens, people will take their money out, they will stop acting and things like that. Uncertainty and lack of confidence are the enemy of economic activity and growth.
I think we need to also recognize that many different conversations we have with the Chinese government tend to have a benign diplomatic flavor. I think we should underscore what has happened this week with the Equifax hack having new headlines. So the 2017 hack of Equifax, which compromised the personal financial records of more than 30%, 35% of all Americans. The Justice Department earlier this week indicted 4 Chinese Communist Party officials affiliated with military intelligence in China. This isn't an accident. This is the same Communist Party that hacked the OPM records and now has moved on to Equifax. Can you envision scenarios where the Chinese Communist Party was hacking into the U.S. banking system?
Well, we need to be resilient against all cyber threats, and certainly, state actors are a big part of that. And so we're well aware of those. And by the way, we have help from the intelligence agencies and others in the government in keeping our eyes out for that.
Shifting gears a little bit, the president's budget came out this last weekend, and some of us are going to be in the finance committee later today discussing the larger budget. We tend to have headlines that focus on whatever the discretionary programs are that tend to be more hot button and current in the news, but you've talked consistently about health entitlements and its challenge to or maybe more broadly than health entitlements, the inefficiencies of our healthcare delivery system. For a developed nation, we have very mediocre health outcomes and we have ridiculously high price tags. Can you talk a little bit about the consequences of U.S. health uncompetitiveness on our larger economy?
I'd be happy to. Of course, should start by saying that it's not really, we don't do fiscal policy and we don't give you advice on fiscal policy, but since you ask, really, the budget, the biggest issue of our federal budget is just it's healthcare spending, and it's not that our benefits are too generous; it's that we deliver them in a way that is, but measured by the outcomes. The outcomes are perfectly average for a first world nation, but we spend 6 or 7% of GDP more than other countries do. And so it's about the delivery, and that's a lot of money every year that you're effectively spending and getting nothing. And I have to leave it with you there. It's not for us or to me to prescribe, fixes, but I think that really is what it's about. It's not, those discretionary things, of course, are very high profile and they get a lot of reporting, but ultimately that's what's driving it. And again, I would stress, it's not that these benefits are fabulously generous. They're just what people get in Western economies. But we deliver them at the cost of 17, 18% of GDP, and others do it at 11% of GDP. That's what we should be focusing on.
Thank you, Chairman.
Senator Tester.
Well, thank you, Mr. Chairman, Ranking Member Brown, for having this hearing. And I want to thank you, Chairman Powell, for your work. I didn't hear all of Senator Reid's questions, but if it has to do with independence of the Fed, count me on that block too. I think it's critically important you maintain that independence and hang to it, and I applaud you on your efforts thus far. Both the Fed through lower rates and Congress through increased spending, through increased debt, have been taking actions to boost the economy during a long stretch of growth. I am concerned that if we do approach a downturn, and there are a number of indicators out there that are concerning to me, that our options to address a downturn are limited. I want to hear your perspective on what the Fed has as ability to react to an economic downturn, the tools.
Thank you. So our traditional tool, of course, is interest rates, and low rates are not really a choice anymore. They are a fact of reality, and they're likely to remain in, so we will have less room to cut. That means it's much more likely that we'll have to turn to the tools that we used in the financial crisis when we hit the lower bound.
Which is?
Which is forward guidance, which says we'll keep rates low, and then it's also large-scale asset purchases of longer-term securities to drive longer-term rates down and support the economy. We will use those tools. I believe we will use them aggressively, should the need arise to do so. There's no need to do that now, but we will use those tools aggressively. The sense of the review that we're undertaking of our strategy, tools, and communications right now, and which we think we'll announce our conclusions on in mid-year, is that we're looking to make sure that in this low-rate environment, difficult environment for central banks and for those who we work for, that we are using our tools as best we can, that we've explored every possible way to find, every scrap of policy space, if you will, to be able to support the economy. And then finally, I would just stress that it's important that fiscal policy be in a position, as it always has been, to support the economy in a downturn as well.
So let me ask you this. The debt's at 23 trillion right now. Isn't that about right? Something like that.
Yes.
At what point in time do you get concerned? I mean, I think the budget the president just put out is another trillion to the debt.
It's very hard to say at what level you get concerned. I would say I'm be concerned now it's really the rate of increase is what we need to do is have the debt grow slower than the economy is growing. If the economy is growing faster than the debt, then effectively leverage is going down. So debt to GDP won't be. What's happening is debt to GDP is going up and going up fairly quickly as these things move. Other countries have managed to get to very high levels, much more than ours. But what it means is that 20 years from now, we'll be spending those tax dollars. Our children will be spending those tax dollars on servicing the debt rather than on the things that they really need.
Right.
We're sending them those bills.
And the debt doesn't go down if the economy downturns.
No, not at all. Quite the opposite.
Exactly right. It becomes much bigger of an issue.
Yeah.
I want to talk about housing because it's a big issue, I think, everywhere, rural America and urban America. From your position, what do you see the housing challenges impact on individuals and the economy?
It's housing is generally facing difficulties in affordability. I mean, the housing industry is doing better and building more houses and profitable, and housing starts are going up. But I think from the standpoint of the public, you have a squeeze going on to do with difficulty in getting lots. With there are just supply side constraints which are keeping the quantity of housing down. Lack of skilled labor, regulations of various kind, and so what you see many places, not just in big cities, you see housing affordability challenges, and it's a fairly wide scale problem.
And I just want to ask this really quickly because there's been a lot of debate for a number of years, and much of it started by my senator to my left on GSE reform. Does GSE reform or lack of GSE reform have any impacts on the housing situation?
I think in the long run, it's very important that GSE reform happen, that we move forward with that. I think that's a big unfinished piece of business from the financial crisis. It's not really ideal to have the entire housing finance system riding on the federal government in the long run. It would be better to move forward with something, I think. And I think in the long run, that's a more sustainable basis for housing finance.
Thank you for your work. I have some other questions on agriculture. We'll put them for the record, but thank you very much for your service.
Thank you.
Thanks, sir. Senator Rounds.
Thank you, Mr. Chairman. Mr. Chairman, first of all, welcome. And I just want to echo what some of my colleagues have said about the independence of the Fed. And I think on both sides of the aisle, you'll find a strong, independent Fed. I'd like to begin by asking you about a rule that I recently filed a comment letter on, and that's the Fed's building blocks approach. As I mentioned in my letter, it doesn't seem to make sense for the Fed to resurrect the original Section 171 calculation from Dodd-Frank. I understand that this particular calculation unintentionally imposed bank-centric capital rules on insurance, savings, and loan holding companies, which have a totally different business model. Congress spoke very clearly through the passage of the Insurance Capital Standards Clarification Act that its intent was for banks to be regulated like banks and for insurance companies to be regulated like insurance companies. Given the clear intent of Congress, why has the Fed chosen to revisit Section 171? How does the Fed intend to move forward?
So thank you for your comment. We got a number of comments on that issue, and we're looking at. Of course, we've looked at the law change, and the question we're asking is whether there's what's the nature of the change made in the law, and does it apply here? So we'll be reviewing those comments and considering them in getting to a view on that.
As you know, one of the reasons for having these open discussions is to bring attention to it. And the fact that I think it's a very serious issue, and I think it does need the full attention of the Fed, and hopefully you'll get it resolved as quickly as possible to avoid any questions that may be lingering out there.
Will do.
I'd also like to talk a little bit about, Vice Chair Quarles recently remarked that business fixed investment continues to be weak, having declined over the course of 2019. Do you think it's fair to say that a large part of this is driven by uncertainty with regards to trade, and that businesses are waiting to see how trade tensions are resolved before they're prepared to make further investments?
You know, I would say there are a bunch of factors that we need to look at. One is just the global growth slowdown, particularly in manufacturing. Another is lower oil prices. In the United States, it's a big swing factor in business fixed investment is drilling. Our work and that of many outside economists does suggest that there's also a role for trade policy and trade uncertainty around trade policy. So, I mean, short answer to your question would be yes, I do think there's upside there to the extent businesses see the trade situation as having uncertainty around the trade situation as having declined.
And I'm just thinking, recently I understand that there's been a discussion about groupthink and about how the Fed approaches it within the meetings. Do you think it's important for the Fed board to reject groupthink and consider a variety of different viewpoints?
I do. In fact, I very much do. I'm strongly inclined to think that you need to hear all sides of a case. In fact, when I was a private equity investor, I used to speak against my own deals just to force people to defend them, so I would really get a sense that I believe in things. So it's critical to have diverse perspectives. I really think we do, though, particularly through the, if you think about it, the Reserve Bank system guarantees from an institutional standpoint that we'll always have diverse perspectives on monetary policy. On regulation, where we get it is from the comments and from the disparate group of people who are on the board. If you look at who's on the board, a number of us have primarily private sector backgrounds, and we bring that to the table.
Pretty fair to say that you can have people from varying points of view that can have very lively discussions and yet, at the end of the day, still be a part of a very strong team.
Absolutely. I really think it just makes you stronger. I do. I mean, I feel that way. And of course, we've had plenty of dissent at the Fed over the years.
Thank you. One last question. When the board voted on its rule for tailoring resolutions plans last fall, Vice Chair Quarles gave a statement essentially saying that there is more that could be done when it comes to tailoring from a supervisory standpoint. Can you elaborate on how the Fed intends to move forward with this?
So Vice Chair Quarles gave, as I'm sure you know, gave a speech on that and laid out really quite a number of aspects of that. And, so we're going to be, these were ideas. They're not quite at the stage of being proposals yet, but we're going to be looking at those.
How will they be manifested? Are they going to come out as rulemaking, or are they going to come out as guidance?
Some of it will be rulemaking, some of it will be guidance, some of it will be changes to guidance. If you look at, there's many, many different ideas. I mean, I think the key thing is he highlights this, the tension between, the right to due process and clarity that we depend upon from our government, right? But also with supervision, there's also a role for discretion and for confidentiality. So I think it's a very thoughtful process of looking at that and asking how can we make it more transparent with more due process, but still effective, because supervision has to be firm but fair.
Thank you. Thank you, Mr. Chairman.
Thank you. Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, great to see you again. Thank you for your good work. I want to make a couple quick comments echoing what Senator Rounds and Senator Reed and others said. I think there's a lot of our institutions' independence are under assault these days. I share some of the concerns of Senator Brown about the independence of the Justice Department. I fight on a regular basis to try to make sure the intelligence community can maintain their independence. I would ask and frankly plead with you that if you see efforts made to undermine the Fed's independence, that you keep this committee fully abreast. I think the Fed's independence is more important than ever at this point. I want to also follow up on my good friend Senator Sass's comments about Equifax. I share with you the belief of the challenge that China poses, but I also think, particularly in the case of Equifax and the credit rating agencies broadly, none of us choose to be an Equifax customer or any credit rating agency. That break-in, that cyber attack, was due to sloppy behavior by Equifax, and the fact that we have not put in place any, frankly, enhanced rules of liability around these credit reporting agencies is something I know I've talked with the chairman at times, I hope that we would come back to, because I think while we have to be on guard, if we don't have at least de minimis standards and they can bake this kind of obscene break into the cost of business, I don't think that's good for anyone. And again, I hope we'll be able to come back to that. I do have a bunch of questions for you as well, Chairman Powell. Let me just, yesterday in your testimony, you talked about this movement towards digital currency, something I'm very interested in. And you indicated, it was possible that there might be a United States-backed digital currency. We have the possibility of doing that. The question is, would that be desirable? How do we, I get the component parts around a digital currency might provide convenience and potentially even lower friction cost in terms of credit to consumers. But how do we weigh in privacy and cyber concerns? How would that deal with our retail banking system? And do you think the Fed has the capacity to do this without congressional approval? Fill out a little bit more, and then I've got one last question about China's role in this space. But talk to me first about the domestic implications.
Sure. So you listed the potential costs and benefits. The benefits would include, perhaps greater financial inclusion, lower costs, more convenience, and all those things. The risks or costs would include cyber risk and fraud risk and privacy risk and things like that. So I think there's a lot to weigh and a lot to work on there. Every major central bank in the world right now is doing a deep dive on digital currencies, and we think it's our responsibility to be at the very forefront of knowledge and thinking about a central bank digital currency.
Would you take a positive action on that without congressional input? Do you feel like you have that authority?
So it would depend a lot on the design choices. It's a good question. One that we're working on. I'd say we're working very broadly, including working with other central banks around the world on this. And there's just a lot of thinking and experimentation and understanding that we're gaining. And if there's a need for, if we conclude that we need more authority and that this is something appropriate to do, then we'll ask for the authority.
Well, one of the things you mentioned yesterday, and I can share Senator Sass and a number of us who are on the Intel community concern about the rise of China in a series of areas. And I think it is clear that China may move quicker than us on a digital currency. You said you've got some visibility into what China might be doing on digital currency. I'd love you to spell that a little bit. Do you think they'll use their influence through their kind of Belt and Road investment strategy and the number of countries that have kind of bought into that system, that they might be then also buying into that Chinese digital currency? What would that do in terms of cross-border? What would that do in terms of dollar supremacy? Any further guidance you might have on your insight into China's actions in this space would be helpful.
I would just say we have to assume that what would that mean? We have to ask the question, what would it mean if China had a digital currency that had fairly wide adoption, including two other countries? We've got to ask that. I think we've also got to ask, what if a private sector entity, a large company with a large network of users has a digital currency? So we're looking.
That's already popped out, and I think we had pretty bipartisan concerns on that one.
So that's why we're doing all this work. We understand I would say Libra was something of lit a bit of a fire. This is something we've been focused on digital currencies for a couple decades, but it's really lit a fire around the world right now. So we are doing a great deal of work.
My time's up. I just want to say I would urge, having seen China's ability to move aggressively in a series of other areas, that you start forging that coalition of the willing amongst other central banks sooner rather than later. Thank you, Mr. Chairman.
Senator Perdue.
Thank you, Chair. Mr. Chairman, thank you for being here again. It's good to see you. I just have one quick question in light of the time. We have two dynamics right now that are driving the economy in different directions potentially. Labor is now a limiting factor in terms of we've got roughly 7 million job openings and about 5 million people looking for work. So it's a phenomenon right now that's a limiting factor. On the other hand, we have low energy costs. Since 2007, where we've doubled our output of oil, such that now we are a net exporter of oil and gas, the largest producer in the world. 8% of our economy is energy. 15% of our CapEx is going to that. Today, we produce 50% more barrels of oil a day than Saudi Arabia and about 18% of the world's output. My question is, are we in a low energy price environment, and what assumptions are you making that over the next decade, and what impact do you think that will have on inflation, deflation? I know you've talked about deflationary concerns in the past. Where are we today on that big factor in our economy, energy?
So it's been transformational. If you think back when we were in college, if energy spiked, inflation went up, people got out of work, there were long lines at the gas pump. We now have a very large domestic energy industry, which amounts to a shock absorber. When that happens, U.S. drilling goes up with the price of oil, puts people back to work, it controls prices, it controls inflation. So we're in a situation where that particular mechanic for inflation going up, it's just not happening anymore because the supply response from the U.S. industry is quick and large. So you won't see that, having sustained effects on inflation, and also you won't see it having sustained negative effects on growth because it kind of roughly offsets the effect of lower energy prices at the pump. That will slow the economy down a bit, but the new supply that comes on will put people to work. It'll be different people, but overall, it's a very different and better place to be.
Are you concerned about the workforce participation rate with the growth of jobs over the last 3 years? Workforce participation recently has bumped up a little bit, but it really hasn't moved as much as one might have thought.
It is greatly surprised to the upside, which is a great thing. But remember that the prediction, basically what labor force, just because of demographics, participation should drop by about 0.25% a year. It's now been flat since 2013. We think there's more upside. So what's happening is labor is tight everywhere, but actually there's a supply response from the public, which is a very positive thing. And we never thought we'd see 63.4% labor force participation again. Nobody had that in their model 7 years ago, but that's what we have, and it's really a very positive thing.
Good. Thank you, Mr. Chairman. Light of time, Mr. Chair. Thank you very much. I'll yield back.
Thank you, Senator Schatz.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. First question, how does income inequality impact economic growth? There's a lot of talk on the policymaking side of the impact on families. How does it hit your analysis, and what can be done on your side of the shop?
Well, obviously people who are at the bottom end of the income spectrum, whose incomes aren't growing, their consumption will be constrained. Their consumption will be constrained, and their marginal propensity to consume out of new dollars will be high. To the extent gains are going to the people at the top, their marginal propensity to consume out of wealth will be low, so that it won't be hitting GDP. It'll be going into savings. So those are effects that will show up, quite gradually over time. Inequality is a gradually moving phenomenon.
Talk to me about the relationship between productivity and unemployment. Is there a new relationship that's emerging? Is there any new thinking along those lines? Because I think the traditional analysis is productivity goes up. That's basically good for the economy. But it seems to me that at least the way people perceive it is that those two things are decoupled. That productivity goes up, that doesn't mean wages go up. And I'm wondering whether that's a change or if that's a sort of more of a political overlay to say, hey, look, things may look good, but we're still on the bottom eating your scraps. I'm wondering whether it's more than that and that there's actually a change in the way you analyze this.
Well, I think we're always learning, and and we've seen relatively low productivity in the wake of the financial crisis, and it appears to be persistent, and that's going to mean lower wages. Ultimately, you need rising productivity to create rising standards of living. It just has to be that way. It doesn't mean in any given year you will see that, but you do see a pretty tight connection between if you add in benefits, not just wages, but look at the full cost of employment. You see I won't call it tight, but you see a connection between rising productivity.
I guess the question is, they're no less correlated than they used to be?
I wouldn't say that, no. I would say if you look at the moment, if you think of wages as being right around 3%, productivity growth has been low, is just recently moved up. It recently moved up close to 2%, and inflation is 2%.
Yeah, the other thing I'd add is that if you're doing total compensation, if most of the increase in total comp is just that the employer absorbed a 7% increase in healthcare costs, that's not really an increase in wages in the traditional sense. I get that from the employer standpoint, it sure feels like an increase in wages, but if you're trying to maximize compensation, it means nothing to a regular person who says, okay, I guess I got no more money, but it costs my employer more, so I should be happy about that. Let me just move on to climate. I have a couple of questions. What's the Fed doing in regard to climate-related financial disclosures? I know you're making some progress. I'd like you to talk about that.
So, I think like other central banks, we are at the beginning of the process of understanding how climate change affects our work. I think one way we know that it will affect our work is that the public will count on us to make sure that financial institutions that we regulate, central counterparties, banks, things like that, will be robust to the risks that come from climate change. And we're at as I said, the beginning of understanding exactly what all that means. In terms of disclosure, it's more really an FDIC issue. They're the ones who regulate appropriate disclosure. I think they've been doing some work on this lately.
You had an exchange with a member of the House, I think it was yesterday, and the question was whether we ought to be stress testing for climate risks. And you said you're watching the Bank of England. I'm wondering if you can elaborate on that.
So they are doing stress tests, which are not at all connected to the CCAR, what would be the CCAR process, which is the one that relates to the amount of dividends and that distributions that a company can have. This is more just exploratory. They're exploratory scenarios, and we're very closely monitoring that. We have good relationships with all the major central banks, especially the Bank of England and others. So we'll be looking at that, and it's something we'll be thinking about. We haven't made any decisions, but as I said, these are early days. We're actually doing a fair amount of work all through the Federal Reserve System on understanding this emerging risk.
Thank you.
Mr. Chairman, thanks for being here. I think you're doing a great job.
Senator Kennedy.
Thank you.
Thank you, Mr. Chairman. Our labor force participation rate is much better. But compared to other OECD countries, we lag. Why?
That's a great question. So it is a combination of things, no doubt. It is that educational attainment in the United States, which was once the highest, has really fallen relative to our peers, and particularly among lower and middle income people, the level of educational attainment has really plateaued.
Right.
And that's the key thing for keeping in the labor market.
What
these
else?
days. That's one. I would say the opioid crisis isn't helping. I would say, if you think about it, both globalization and technology probably advantage people of relatively high education and don't advantage people, for example, in manufacturing. So if you think about what's happened to the manufacturing base in many, many countries, a lot of those jobs have either been automated or moved abroad. The manufacturing that we have now is very efficient and doesn't use as many people.
What else? Has trade played an impact?
Sorry?
Trade
Yes.
tariffs?
Well, I would say trade tariffs. Through this period, we really have had declining tariffs since World War II until lately here. And we've had increasing labor force participation here because of this underlying strength.
Does the richness of our social programs play a part?
It's very hard to make that connection, and I'll tell you why. If you look in real terms, adjusted for inflation, at the benefits that people get, they've actually declined. During this period of declining labor force participation, they have not gone up in real terms. So it isn't better or more comfortable to be poor and on public benefits now. It's actually worse than it was.
Right. It seems to me that and there's going to be a question in here, I promise. it seems, I know sometimes you never get one, but
That's okay.
it seems to me that any fair-minded person would have to conclude that our economy is better. I'm biased, of course, but I think the Tax Cuts and Jobs Act worked. And we have seen wage increases, including but not limited to the bottom quartile. And we have seen unemployment go down. But we still have a problem in America and a lot of anger. And I think the root, this is one person's opinion, but the root of a lot of that anger is that we still have too many people in this country who aren't participating in the great wealth of this country. Not economically, not socially, not culturally. I think Sanders supporters and Trump supporters have more in common than they realize. The American dream has become the American game to them, and they think it's fixed. Now, the managerial elite's doing fine, but I'm talking about ordinary people. What, if any, role do you think the Fed should play in helping us address that?
First of all, I think there's a lot in what you said. The single most important thing we can do is take seriously your order to us to achieve maximum employment. Maximum employment, that's what the law says. And that's what we're doing. We're using our tools to keep an eye on maximum employment, and I think there's no reason why the current situation of low unemployment, rising wages, high job creation, there's no reason why it can't go on. It really isn't. There's nothing about this economy that is out of kilter or imbalanced. That's the main thing that we can do. We do other things that are in the nature of convening. We do a lot of research in your state and others. The Federal Reserve Bank will have an operation where they're trying to convene resources around issues of education and poverty and things like that in poor communities. But we don't have the ability to spend money on it. We just do. We get community people around a table and try to organize things that help the community, as I'm sure you know. So it's not really something we can do a lot about other than research and do our jobs on monetary policy.
Thank you, Senator Kennedy.
Well,
Senator
I
Cortez
think if I could have another 10 seconds, Mr. Chairman, I was distracted because you were talking. Stay independent. I think you're doing a great job, and all of us in politics are going to give you plenty of advice, but call them like you see them. Thank you.
Senator Cortez Masto.
Thank you, Chairman Powell. It's great to see you again. Thank you so much for being here and always being responsive. Let me follow up on this line of discussion of maximum employment, and I so appreciate the conversation. You keep talking about a level of educational attainment that is so important. What do you define as that education? When you talk about that, what does that mean?
Anything that gives you skills that would work in the workplace. That could include internships. It could include the kind of training that people are getting now who go right out of high school into a program. It's not meant to be limited to college as such or getting a liberal arts degree. It's really the acquisition of skills in society.
So, do you think we have changed in society that it's very difficult now to just graduate from high school and get a job that pays a decent wage for your family without getting some sort of additional education?
Yes, it is. I mean, I think you see that very much. For people with high school degrees, their incomes have stagnated, badly for a long time. It's the economy. What happens with technological change is that it wants higher and higher levels of skill, and if society provides those people and those skills, then incomes can go up across the board and inequality can go down. And that was the American story for a long, long time.
Sure, but it isn't part of that, and this is why I'm curious your thoughts on this. Part of that also has to do with the wages and the increase in wages and the level of wage that you're paying. Are you saying just because you graduate from high school, you shouldn't, and you want that job, whatever that job is that you're able to do, it should be a minimum level of wage that should never increase, even with the gains in productivity that we've seen over the years?
No, I'm not saying that at all.
Okay, good, because I agree with you. Because I think there are also people in this country, and I am pleased with the high unemployment rate, but I also think, and they live in my state, that are working two jobs. They're actually working two jobs because the wages are so low. And I think there is a disparity that we have to do a better job of understanding. I was looking through the monetary report that you gave, and I'm curious, do you identify, because I didn't see it here, but do you identify those individuals who are actually working two jobs?
Those are identified in the data collected by the Bureau of Labor Statistics, yes. And
And that's what you utilize here, and is that data that you can provide that gives us a better
Sure.
understanding of how many Americans across this country are actually working two jobs just to make ends meet?
Very high level right now.
Yeah, and that's what I would like to see. I think that would be helpful
We
for
can
us
share
as
that
we
with you.
work with you moving forward. Let me just, one final question, because I know the votes have been called. You note in your opening remarks that there are troubling labor market disparities across racial and ethnic groups and across regions of the country. Can you go into more specifics with that statement?
Sure. So I think we had actually had a box in our monetary policy report, I think a year ago, about the rural and urban disparities, which are just getting wider and wider and wider. And it talked about, what might be causing that. And, you really have a long-term trend here that's challenging for people in rural areas. In terms of racial and ethnic disparities, I mean, the African-American unemployment rate is roughly twice that of the overall unemployment rate. And, that you see different groups. And so it's troubling that these things would persist in this way. We don't have the ability to operate directly on that, other than, again, by carrying out our mandate of maximum employment and stable prices.
But as you study it, what are you finding? Why is there that disparity? What can you point to?
Which disparity?
That would be helpful, the racial disparity that you just talked about.
I think it's tied into history, to our history, and there are higher levels of poverty in the African American community, as you know, and that's because of our history. But we'd like to see those gaps declining more than they are.
Okay,
not tools that we have, tools that you have to do.
But there's nothing, and what I'm looking for is the data. There's no data set or data points that you're collecting that helps us identify that racial disparity, why it's occurring, and how we can address it.
Oh, there's lots and lots of research on that. We'd be happy to.
That you have access to.
Sure.
Perfect.
Yes.
That's what I'm looking for. Thank you.
Senator Tillis?
Thank you. Chair Powell, welcome back. Thank you for a lot of the good work you're doing over in your lane. I do have a couple of questions. The first one that I want to talk about, we've seen, particularly in the FDIC, we've seen a real stepped up effort to take a look at guidance and other actions short of an APA promulgated rule to rethink and revise or rescind. Can you give me an idea of how that's going on in the Fed?
Sure. So, we've forthrightly said that guidance is not a rule. Guidance is not binding. It's not the basis for enforcement actions and things like that. And we've made that very clear to our supervisors. So I think you may have seen Vice Chair Quarles' speech where he addressed some of these issues. So we're working on that as well.
The one, if we drill down, I know you're aware of the GAO ruling on LYFT. There's a lot of talk here. I happen to agree with the discussion that you all need to remain independent, but there's something that concerns me that came out after you received the word from the GAO or OMB, and it relates back to, I think, a letter your general counsel wrote back in June of last year, which I have it in front of me now. It says that you're continuing to assess the scope of the Federal Reserve's obligation to send supervisory guidance documents to Congress under the CRA. Does that mean you're exempt from that oversight?
So the question of whether we're required to send guidance. We do send some guidance up. And again, this is another one that Vice Chair Quarles
So what's the current position on the LYFT consultation from the GAO?
So
Are you taking LYFT down?
On LYFT, what we're going to do with LYFT is we're going to, I think, articulate clear standards for what firms should be in LYFT. In fact, Vice Chair Quarles already laid out an approach which I think makes a lot of sense, which is LISIC should be for the USG SIBs, and really try to tie the whole approach more to the tailoring categories that we set up.
Now to the other CRA, that's the Community Reinvestment Act. Well, one question, rumors swirl around this building probably the way they do in the Fed and the whole of government. So the question that I have is that relates to the Fed's plans for either joining with the FDIC and the OCC on the rulemaking. Some have said that you provided an assurance to Waters that without Governor Brainard's support that you would not join into that. Is that just a rumor or an assurance that you've given Chair Waters?
That's not how we're looking at it. What we're doing is we're trying to we developed our own thinking on CRA reform, as did the OCC. They took a lot of our ideas, but in the end we were not able to get on the same page. And I'm very comfortable with where we are now.
What would be the rational basis for two standards?
They're going to be two standards anyway. Under the FDIC OCC proposal, about 70% of their institutions will be able to opt out of that standard. So there's going to be the existing standard, and then there'll be the new standard, assuming that they go forward with it. So there'll be two systems, and we'll just be, if we don't do anything, then we'll just be like the 70% of the institutions that they supervise.
Is Vice Chair Quarles on point for this?
Is he on point for this? He's
wouldn't the Community Reinvestment Act be within his lane?
It's certainly broadly within all of our lanes on the board. We'll all have to vote on this. This actually has always been handled by a different group, which is DCCA, which Governor Brainard chaired, and I asked her to take the lead on this. But ultimately, it comes down. I am very comfortable with where we are on this.
Thank you. I was going to ask some questions similar to Senator Toomey's. I won't on Fed Now, but I'm only going to submit some questions for the record that are just basically about the mechanics of the Fed Now implementation. 5 straightforward questions. Thank you.
Thank you, Mr. Tillis. Senator Jones.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Let me echo other colleagues on both sides of the aisle regarding the independence of the Fed. I concur that it is extremely important that we maintain that independence. I want to ask you a little bit about home ownership. It kind of follows up a little bit with what Senator Kennedy was talking about, wealth gaps between so many Americans. It seems that nationwide home ownership is relatively stable, but there is also massive disparities in home ownership by age, race, ethnicity. African-American home ownership rate fell to a 50-year low in 2016 at just 41.7%, remains about 30 points below white home ownership. Similarly, Hispanic ownership rate is just 48%, again, far below the white or average home ownership rate. Millennials are less likely to own a home by age 34 than their parents or grandparents, and I'm concerned that if trends continue, and by that I mean to some extent, we've got relatively the wages are rising, but they've not been rising as fast as we would like. Home ownership costs are increasing at a greater rate. So I'm concerned that if these trends continue, a growing number of Americans are just going to get locked out of home ownership. So my question, what are the economic consequences in terms of both wealth building for minorities and the broader economy of leaving this disparity in the realm of home ownership unaddressed? And do you have suggestions of how we in Congress or the Fed can address home ownership?
Let me say first, I would agree with you that there are pressures on affordability which are very widespread that to do with difficulty in getting land zoned and difficulty in acquiring workers, and just costs, regulatory costs, material costs are really putting pressure on house prices, upward pressure. And it's, as I said, quite widespread around the country. In terms of the level of home ownership, I think we don't want to be back in a situation where we push the idea of home ownership past what is financially sustainable for people, and we kind of did that in the pre-crisis era. So what's happened is that credit is much less available now for people without spotless credit records, and that's a lot of what's behind some of the data you cited. And I think it's a good question. Do we move too far? I don't have a view that we did, but I think it's a good question to be asking on that, and just making sure that people who should have access to credit and can handle borrowing of that size get it.
It seems that, and I know Senator Cortez Masto was asked, I'd like to get some of that same information, by the way, about the racial disparities, because I assume there is some connection with that in economics as well. Let me, in the short time I've got left, go back to the lower rate of labor force participation. How can we just encourage that? How can we get more participation and get those numbers up? What can we do? What can you do, if anything, to try to get more folks in that participation in the market?
So what we can do is continue to use our tool to support a strong labor market. And it's very good to see those participation rates rising to the levels that people didn't, economists didn't think we'd see those levels again, and we're seeing them, which is a really positive thing. But that's, longer term, that's not really a strategy for, we need policies that will, ultimately people have to have skills and aptitudes that will keep them in the labor force, and ways that they can take part in the labor force. And I think that's where other government policies come into effect. And, it's a lot of education and training, and also policies that will support attachment to the labor force. And there's a lot we'd be happy to sit down with you and talk about that. But that's important. Other countries that have leapfrogged us do more of those kinds of things, and also have had more rising educational attainment, which I think all of those things will help.
Great. Well, thank you for that, and I look forward to discussion about that a little bit. Thank you, Mr. Chairman. I'll yield back.
Thank you. Senator McSally.
Thank you, Mr. Chairman. Chairman Powell, on February 2nd.
Okay, that's enough of that. Yeah, they keep, Darce, right. It is interesting. This is stuff that if you guys want to be trading this for a career, this is the kind of stuff that you're going to have to deal with. It's not all fun and exciting. Like, a lot of this stuff is, it's a lot more important than you would assume. A lot of what they're saying is the same stuff over and over, but at the same time, when somebody keeps saying something, it's there's a reason why, and it's something to keep your eye on. Some of the things that I think were really important was some of the stuff they were talking about with home ownership and homeowner growth. There's been a huge downtick in home ownership. A lot of the money has gone into So it's this thing that we were talking about before, where the new generation, as they say, is more renting, not buying, blah blah blah. Well, that's not true. They're actually seeing the entire industry is actually on a rise, and it has been since November. New home sales have actually been increasing at a higher rate than they expected. This is what they thought was going to bring on the recession, so to speak. That's what they were saying just a year ago. That's pretty much out of the cards. And so it doesn't seem like they're saying things that are really that important when you first just listen to it, or at first glance, or when you don't really know what to look for, or listen for, I should say, not look for. And that's fine. That's a part of, learning this game, and it's a part of, knowing what to listen for. It's always these little subtle clues. Every single large event that the Fed has given, there was always, and you can go back and look at this, there was always subtle clues in the weeks to months prior to any big move being made that they would go over. All of the cuts, all of the increases in 2018, all of them months before, they had said something alluding to what was about to happen. As of what he said today, they keep saying that same weird dovish stance of that they'll keep an eye on this and they'll keep an eye on that, and if they need to, they'll adjust. Well, to me, what would be absolutely insane is if they had a further rate cut. I can't believe how many analysts I see lately saying that they definitely see a rate cut in the cards for this year. When we're breaking all-time highs, today 33.77. The only thing I could see really happening, and this would be something what would happen with Trump, is as we get closer to election. So say this thing on my timeline really does dump. especially like into summer, like like May, end of May, April, May, even into June. If this thing really dumps and we get like a significant, pullback into like 10%, 15%, it would have to be that drastic and that large and quick. And there'd have to be some other macro event that, like the virus could have been something, right? If this thing just spirals out of control and we end up dumping 10%, then there's an event where I see the Fed saying that they need to step in for another rate cut. And I think this would all come from Trump, going into election, freaking out, because this has pretty much been his political, soapbox this entire time, is that how good the economy is doing. And it is actually doing. But the problem is a lot of people on the lower end, they're not seeing the effects directly. And even though they don't know it, and maybe they are actually being affected positively, they don't see it directly. So they get all angry and they get mad and they say comments that are very ignorant and very unfounded and uneducated. Now, the thing is that's the way they feel. So I'm never going to take away from the way somebody actually feels. I would have to disagree, and there's many things I could point out, usually most cases, to disagree with them. But the point is that all those people are voting people, and most of those types of people are on Trump's team, so to speak. So, I mean, a lot of the stuff with, a lot of the stuff that he was talking about is more higher end, like higher education and, tech issues, the issues that they've been facing with cybersecurity. The day-to-day person in North Dakota and Iowa and Nebraska, they don't care. They really don't care. They want, at the end of the day, they just want to know that there's going to be a little bit more money in their pocket and they're going to be able to afford their bills at the end of the month. That's it. They're living paycheck to paycheck, right? So a lot of that stuff, the stuff that you need to be paying attention to, in my opinion, are these subtle clues about, watching like the emerging markets and watching the virus stuff. Now, what I would see with the virus stuff, only thing I could see really negatively impacting us now is going to be if we start seeing multiple deaths outside of China. I think at this case, if China just completely melted in half, I don't even think anybody would care. I think it's almost expected, and it seems so far away. But I think if we start seeing like a couple deaths in the United States, some deaths in Australia, some deaths in the United Kingdom, then I think people start, really panicking, and then we see, a huge, disaster type of scenario. As it stands now, it seems like they are on the decline, at least for now. Again, how much of that is true, I don't know. I think there was a lot more to it than what actually happened. I think this was used for many, many different reasons, but I think this was used for political gain as well as I really trace this back to a few things, and I'm not going to get too tinfoil hatty here, but I definitely have my suspicions of what really happened here and what really is going on to this day. But I don't think it's anything we need to worry about. I think the biggest thing here is that we are at levels that are so overextended that, I mean, right now, if you look at it going long right now, what are you looking at? A couple points. And so there's so much risk to the upside. So what I've been trying to explain to everybody, and what we're trying to show you guys, especially in Discord, is that there's nothing wrong with taking, long trades. Right now, most things would be silly to take a short on, because there's no price indication. There's no event to lead you to that. But what I would be saying is if you're going long and you're taking more positions, especially overnight positions and longer term swings, is reduce your size. And I know for most of you that's, it wouldn't be a problem anyway, but honestly, like if you're going in all in and you're going long, I mean, that's just stupid. I mean, you might come out on top a few times, but I can tell you in the long run, that is not a consistent strategy. And you will blow up eventually, because the one time, and that's the thing with a lot of these guys talking about futures, I definitely recommend everybody looking into it and learning how it works and at least watching those levels. But the one time that thing turns on you, it's disastrous. They literally call futures the widowmaker, because it literally can turn on you and just drop. And I mean, we're talking 100 points like nothing. It can drop. I mean, like overnight, it was 12 points. You were risking a potential, you could have lost 50, 60, 70 points. Granted, we know these levels, and we always are stressing setting stops and stuff like that. But I've actually seen it, and this has happened to me personally many times. It will blow through your stop, and there's been times where it won't trigger. And if you're not awake or you're not ready or you don't have your alert set, you wake up to a horrible, horrible situation. So and I'm not trying to scare anybody. I'm just, heed the warnings. Some of the other stuff they were talking about with regards to foreign policy stuff, the only thing that I really got out of what they're saying is that it's been kind of a front-running scenario on these China stocks in years past, and now it's kind of flipped. I think what's going on, in my opinion, is that nobody is trusting any economic data that comes out of China. I mean, it's going to get even more and more difficult because they were, just a year ago, everybody had been putting all this faith in that they were on the verge of becoming, they were going to overtake the United States. They were going to be the one and end all economic powerhouse. And we've all seen what's happened. Most of the numbers were fibbed. They weren't even correct. They're lying. They're manipulated. They have huge problems, and a lot of this, I think, came to light. And I don't know if many of you will know what I'm talking about, but last summer. And this has happened before, especially with like a bunch of biotech startups, is the short sellers would. They would know something was going on. They would see these numbers that didn't add up. And so they would physically take trips to China to see what was going on. And they started noticing that a lot of these places were completely manipulated. They were fake. They would show up to these addresses where the business headquarters were at, and there were all these bio stocks when this first happened. And this was like back in like 2015, but last summer there was a documentary that put out on it, and that one was about real estate and housing. And it was crazy how many of these things are empty buildings. Like, you want to talk about like a ghost town. There are literally cities in China, literally cities with high-rises, skyscrapers that are completely empty. Like, they should be housing like 500,000 people, and there's like literally like 2,000 people. It's absolutely insane. So they've started to notice that they just keep building, but they don't know what they're building for. Like, it's almost ridiculous. Some of the other stuff they talked about, just briefly, they touched on some of the new, as I call it, the new space race. I think the big thing there is that we're going to see a lot more from some of these companies that we have already been following. I guarantee you're going to see a surge in like AI. You're going to see a surge in more companies like SPCE. It's just stuff like that. You're going to see a lot of like penny stock ones that come up. So just be very careful on those and the IPOs that pop up. Really, it was just kind of the same old, but again, it's like the more that they say some of those things, the more that I really wonder. It seems like the only thing the market really reacts to off of that, it's the rate cut stuff, which is kind of funny because it's kind of the least of my concern from what they bring up. But I mean, it's interesting. Some of the antitrust stuff they were talking about too, and that's all in there. It's all of them. It's Amazon, Apple, Microsoft, Google, and I can't remember who else. But I know that Google is and Facebook. That's right. So I mean that's pretty big. I mean, then the FTC is ramping that up too. All of the investigations on Amazon, Apple, Facebook, Google, Microsoft. That's pretty significant. I mean that could get crazy. And if you think about it, all those names I just named, I mean that's essentially all of FANG except for Netflix, right? and that could turn things around, because if that gets ugly and those start coming out with multi-million-dollar, if not billion-dollar, fines, it'll be really interesting to see what happens with Google. They're in court, like I said this morning. They're in court today with the European Union. They briefly touched on it in the Powell speech, but that's not really part of their deal. So there's no real reason for them to go into it. I just think it's interesting that they brought it up. So to me, that it means that more people are watching that. And obviously, we all know that if that turns negative, that's what's been holding this whole thing up. I mean, tech has been holding this up, I mean, the financials have been there too, but the financials are really weak. The financials, basically a flick of the finger and financials are going to fall over backwards. The banks are just not making what they can, especially with these reduced rates. This is really starting to hurt banks. And this is exactly what I had said a few months ago, is that right around now, especially going quarter two, we're going to start seeing these banks, especially that will report like in the Russell, because there's a lot of like mid-cap banks in there. You'll start seeing a lot of these numbers just kind of getting lower and lower, and they'll slowly release it. They're not going to just just all of a sudden completely go belly up. They wouldn't allow that to happen, but that is what we're going to see for sure. So what else did he say in there? Not really much else that was important. I'm looking through my notes. I was taking notes while he was talking. Yeah, I think DT and I have talked about that movie a few times. It's pretty good. There's a couple of them. I'll find the links, or maybe he can too, and we'll post them up. I think it's something that everybody should watch. Not that I'm saying that it's gonna like give us great trades or anything. It's just something interesting to know about how it really is working and what's really going on. And again, it's only what they're allowing us to see, right? It's only a part of the picture. I mean, so what I always say is, if they let us see that much, imagine how bad it really is. That's what I always think. Is like, if they let us see this much, then it's twice as bad, right? It's kind of like the drunk driver scenario where they're like, well, how many beers have you had, sir? I've had 3. Well, that means 30, right? Like, multiply that times 10 no matter what they say. So it's kind of similar. It's like when it's like, oh, well, it's slightly negative, then we know it's really negative. Like there's always more to that than anything. But let's take a look around the market here real quick. I think this latency thing is working quite a bit better. It seems like it's kind of gotten slower since I first turned it on, because like when I first started streaming, it was only about 8 seconds. Now it's going up to, it's like almost like 12, 13. That's a lot better than most anyone else and that we've seen before. So I'm trying to figure out a better way to what else I can do next. I mean, this is about as fast as I can get it through YouTube. Obviously, depending on the service, but even like, I mean, even some of the programs that are made directly for doing this, for like conference calling, they're still around. I think it's like 9 to 13 seconds, and they're going to get better. I mean, that's another thing, just technology will improve on. I mean, I can only imagine what this was 10 years ago. You wouldn't be able to do this. So one of the big things I wanted to look at here, so we'll go across from the top. So you can see XLP, which to me is important to watch because it's kind of the opposite of XLF. So with staples, so XLF, you can see the financials have really backed off there. I mean, not huge, but it is starting to come down, which I think if tech doesn't hold up here, this will start pulling this back down. Remember that level that we were watching is 33.77, which happened to be the new all-time high, but that is significant that it needs to hold up, especially above 33.66 for the bulls. Otherwise, it's going to start getting a little bit ugly here. So oil has backed off a bit, still up nice and high here, up over 2.2% at 51.04. It did hit that high of 51.73, and this is one of the best days that oil has seen in like 5 weeks. So this was important. It really needs to hold up over these levels. Like I keep telling you guys, there's those levels 50, 55, 60. 50 is where they start, things get ugly. Remember, if you guys remember what I was talking about a couple weeks ago or last week, I can't remember, but it really needs to hold on to these gains. I posted that those economic numbers that just came out on the oil, and I'm actually surprised we didn't see a bigger drop, being so over inventoried, because remember, oil works reverse, it works backwards. So it is kind of strange that it didn't have really any. I think it was just so far down and so low that there was really no way to go. So continuing going down on the right hand side, gold is starting to push back up. It is just now in the green here. It is pushing up though. After that little bit of sell-off this morning, it's starting to push back up. 10 years and bonds are still down decently, but they have came off of their lows, so that'll be something I'll keep an eye on going into the afternoon session, just to as as a bearish divergence. The NASDAQ looking nice and strong, still like very strong here, up 72.5 points. So it's still up almost 0.76%. So NASDAQ looking really strong. See if it can't drag up the ES with it. Same thing has happened yesterday. The NASDAQ was up super high in comparison to the Dow and the ES, so it could start to pull that up. I think there's enough time in the day that it could work this time. Yesterday, they didn't have as much time, I think, to pull it up is kind of what happened. But NASDAQ looking really bullish today, so could continue to pull it up. The VIX continuing to fall down. We are at 1428, which is negative 5.93%, so just under 6%. Remember the VVIX, though, the volatility of the volatility is still up about 2.21%. Let's go over to our FANG stocks. So you can see Facebook continuing to climb here, nice and strong. I mean, look at this nice, just beautiful push up here, just right off of that level, that 209.37. So it's pushing up nice and strong. So it's up 1.5% here at 210.36. Apple still making a beautiful push up this morning, up 1.5% as well at 324.33. Amazon pretty much just chopping kind of all around. It's up about 17 points here, but that's about just under 1%. So still good. It got a lot of gains in the pre-market. It pushed up to around 21.80 and then sold off down to about 21.58, I think. But starting to push back up here, already up to 21.70, so that's good. Netflix continuing to push up here. Did have a high right out of the gate at 380, starting to bid back up here around 378.16, so it's still up 1.2%. Would love to see Netflix get back up to that 380 today. It would be amazing. Google struggling pretty hard today. I think there's probably a lot of doubt in that right now just because of them being in court today with the EU over these antitrust allegations. It is up still, though, about 0.33%. And Microsoft is still down about 0.5%, but coming off of those nasty lows of 181, already pushing back up here about 183.55. So if we could get that back over, recapture that 184.37, and then push up to 185.33, that would be significantly bullish. At least they'll keep it in the running for sure. So let's see here. Where are we at? Oh, I need to look at the at my momos. Boeing pushing up here, did hit a high 349.95. We are still sitting around 346.95, so up about 0.75%. Roku is still up about 0.5%, but it did start to sell off, similar to yesterday, but a lot quicker than yesterday. They do need to definitely keep that upper celt intact, or it could start to get a little bit bearish there. There is a nice bullish cross on the 14 over the 30 on the way up on the 4 hour here. So Roku is still very bullish in my opinion, even with these little sells off here. It's still one of those things where Roku moves so much when it wants to that as long as it holds those 4 hours, it's gonna look nice. Activision is up still 2.4%. Shopify selling off pretty hard from those highs this morning, but it's still up $61. So it's still up 12.5% at $554.41. But it did definitely, there was a lot, I'm sure it was massive profit taking. When something jumps up like that, where a lot of people were holding, and I'm sure they were holding from those low 400s, a lot of these people. So I'm sure they were taking profits left and right. So not too surprised. But we'll see where that thing ends up today and see what we get going into next week. So, I mean, I'm already out. I had everything set for open, so it's not like I kept anything in there either. Same with NVIDIA, did the same exact thing, but it's starting to push back up here now. So it's looking nice and bullish. Keeping that 266.44 is a really significant price level for NVIDIA. So it's been doing a very good job of that the last couple days. It's still up 1.46%. And Tesla's still holding up green here, so it is still up about $3.67 at $778.05. It definitely needs to try to hold above this 14 MA. Right now, it is literally sitting just about flat on it, so that'll be interesting to see where we end up with that. But I'm really impressed with how well Tesla's been holding up so far after that huge run up to 968. And it did not completely crash like everybody said it was going to. You know, it's been holding up very, very well. So this is actually really good. It's kind of resetting everything, right? So it can continue to consolidate, and this could be an amazing trade in the next couple weeks. even into next week if it continues to consolidate like this. I really like it. I'm going to do some more charting on Tesla today, so I will post that stuff either tonight or in the morning. But I'm really liking Tesla holding these consolidated levels up here. Nothing looking ugly at all to me on Tesla, to be honest. China stock's looking very, very strong this morning. Still looking strong. BABA is still up 3.23%. BDU is still up 2.84% at 137.79. So very, very nice day for the Chinese stocks. Both of them holding up on the upper count on the 4-hour. You can see BDU just literally bounced right off of it, picture perfect. BABA holding up over that 14 MA. That also had a bullish cross on the 14 over the 30. So it's looking very bullish in my opinion, and so did BDU. So they both are very similar. They both have crossed the 14 up over the 30 on the way up. So these are both looking very, very bullish. Bullish crosses looking very, very nice. AMD hit that high this morning at 54.85, but then slightly selling off here, so it's back down, but it's still in the green about 0.3%. Qualcomm still up about 2% off of that high of 92.44, still holding on to the upper Celt. You can see it just bounced right off of it as well. Disney, just beautiful little mid-Celt bounce right there, and starting to push up. It also had a bullish cross on the 14 over the 30 on the way up. So I am looking for a move here coming up in Disney. I would love to see that thing get above the 14 MA today, and that would be something looking towards like next week for a nice bullish move. McDonald's looking really good this week. After selling off pretty hard last week, it is looking really, really nice right now. It's trying to go for that upper Celt as we speak. It is up only about 0.28%, but still, for McDonald's, it's slow and steady. McDonald's is one of those nice movers. It's not super expensive to play, and it moves really, really smooth. So it's always nice to play that one for longer durations, and it's not expensive, so it's always like a good one, I always think, for people to start out with too. So you can see the market continuing to push up on internals. The breadth is still continuing to rise, so positive volume pushing up. Ticks aren't super strong, but they're not super weak either. Ad decline is kind of just chopping around here, but it's still above my 600 level where I start to look the other way. Sitting at an 846 right now. The low is 771. So ad decline looking good, breadth looking good, and ticks are holding up. But definitely been a nice little rise here from 1030 up. So we're starting to try to get back up to that all-time high level of 3377. Yeah, and I don't know how many of you guys are in booking with us. I'm still holding on to. I haven't sold anything yet, and I don't think Attic has either yet. But definitely still looking very, very bullish in my opinion. So I may try to get out of a few of those positions into this afternoon. But I was looking. If you look on his chart, I'm looking at those double yellow lines. 1974 is also would be a significant level. So that's kind of what I'm looking for as well. Sorry, I was looking at this, watching this thing on. I'm watching the stuff on the antitrust stuff with Google. I don't really think much is gonna happen. I think honestly what they're gonna end up doing is I think Google's gonna end up trying to tie them up in court as much as they can. The problem is that a lot of what they did, and especially Facebook as well, is and all of them, Apple, Google, Facebook, they're all guilty. Like they all definitely did what they did. Do I also look at gold? Yeah, every day. I mean, we were just looking at it. That's what this is on the futures map is, that's probably one of the most important things that we watch. I was talking about it this morning here. So yeah, it's always this one. So it's always /GC. So I play the ETF a lot also, GLD. And then sometimes we play some of the miners like Nugget and stuff like that. But yeah, we're always watching gold. That's why this is my futures map. This is not just something here to look nice. This is something that I literally live and die by. All of these things on here are on here for a reason. Basically, like my bearish divergences are XLP, gold, 10-year bonds, or 10 years and bonds, 10-year notes and bonds, because these will kind of show, see TNX /EN /ZB /GC and XLP. There's other ones I could use outside XLP, but it seems to be the best. I like watching because usually like risk on, risk off types of assets, and so it's nice to kind of get a look from both sides. So as you can see here, like XLF is starting to sell off, and XLP is starting to push up really strong. Gold is starting to push up strong. Oil is trying to sell off. These are starting to, bonds and 10 years are starting to push up here strong, but price action is still rising. So technically right here, we have a bearish divergence actually right now. So even though price action is pushing up strong, as all these indicators are also pushing up. So there is quite there is a divergence here. So I wouldn't be surprised to see if we get another pullback, but this, it's going up there. And if this thing gets over 377 and holds, then it's going to get ugly for sellers real quick. But you can see gold is really pushing up strong here right now. So it's really interesting that it's pushing up with price. So it is very interesting. Yeah, and Addict's right. He's saying that if you need to hedge, perfect time to get in would be this 381.93. So I would wait. I wouldn't go in just yet. But if you're looking to hedge, you're going to get a heck of a price if you can wait just a little bit. If this thing continues to push up like it looks like it's gonna. But there's definitely a divergence going on here. Let's look at the. So breadth continue to rise. Ticks are slightly negative and kind of flattening out, as you can see on here. You can kind of let me back this up so you can see a little bit even more from this morning. Yeah, you can see it pushed out of the gate up. Stop doing that. Pushed up out of the gate, and then it's just kind of now it's been just kind of trailing sideways. So and then on the add divergence, let's blow this up so you don't have to see as much from yesterday. There we go. It's actually somewhat on the rise. So yeah, so as I was just saying, you can kind of see those bearish divergences, and that sometimes happens, especially for like intraday scalping. But you can see there that like everything that would be on a positive, like XLF, the pushing up, and then but all those bearish divergences with the gold and 10 years and bonds starting to push up, that is quite the divergence. So it's unique to see. It happens a lot more in lower levels. Up here it's been really slow, and I think that has a lot to do with the lower volume too. But yeah, it's just interesting to see that. So I think the buyers are definitely in control. Sellers pretty much lost it overnight. But they're going to try to regain it, and they know that 33.77 level is super critical. I do think though that if we get over that, we are definitely on our way to 33.81, if not 33.93. And we're getting up there to that 3400. And like we said, I think I put it at, did I say next? Yeah, next week. So pretty dang close. We'll see. Kind of depends on what comes out, though. I don't think there's much more that could really weigh on this. So. And remember, time is definitely of the essence on a lot of this stuff. Oh, he is trying to call me. I was like, I kept seeing Messenger like flashing, and then it would stop, and then he would call back like 3 times. I will be on here still. Obviously, you'll see me moving around and stuff. And I'll be able to talk through chat and all that. I gotta get on a call with student, but I should not be on there for too long. I know he's got class today, but he needs he's got a lot of positions to get out of, so I just need to help him make sure that he's setting his prices right. Because a lot of times this is something that I want to explain to a lot of people, and I'll get more into this in some of the lessons that we release later this year, is as soon as I open a position and as soon as I get in the position, I immediately start setting up my sell prices. And a lot of times I'll set them at sometimes what you could consider like, well, that's just kind of crazy, because you never know. And so that's why sometimes you guys will see when I get filled and it's like almost top ticked. It's not because I was like right on the gun and just waited. It's because I set it to there so that the moment that it just even spiked and touched it and somebody for some reason decided to meet me there, I was able to capture that. So I never usually wait. It's very, very rare that you'll see me wait to put in an order. I almost immediately put the order in after I've been filled. And I'll explain more about that, why I do that. But yep, I will be here, but let me just help him out, and then I will be back on in a few. Thanks, guys.
What we do here is go back. What we do here is go back. What we do here is go back.